In this video, I'm going to walk you through the single strategy you need to achieve profitability when trading ICT concepts. This approach is built around ICT's turtle soup model. Turtle soup, guys, is all you truly need to become a profitable trader. I'll be breaking down the rules shortly, and if your attention span is extremely short, you might as well turn the video off now and go watch something else. Trading is not easy. If you can't sit through a 15-minute video that simplifies the entire process for you, then you won't be able to trade consistently. Trading demands effort, and if you're willing to watch this video from start to finish, I'll show you exactly how to make this strategy work. Guys, becoming a profitable trader is not simple. This is not fast money, and you have to put in real work. You can't just watch a 2-minute clip and expect consistent profits. So make sure you watch the entire video, take detailed notes, and only then will you be able to make money in these markets. Now, let's begin. What are we waiting for? We are watching the time between 8 p.m. New York time and midnight New York time. This period represents the Asian session. This strategy is executed during the London kill zone and the New York kill zone. What we are waiting on is for the Asian session to complete its range. Asia can move however it wants, but once the clock hits midnight New York time, we will go ahead and mark out the Asian high and the Asian low. This time, we will wait for price to take either side of the range. In this example, we are waiting for the market to take out the Asian low. Once the Asian low is taken, our bias for the day shifts to bearish, not bullish. In the Asian strategy I shared before, we would usually wait for a market structure shift and look for longs targeting the Asian high. That is not what we are doing here. If Asia low is taken, our directional bias becomes bearish toward the downside. So after that, what we are waiting for is the market, once it has taken out Asia low, to seek buy-side liquidity at the Asian high. We want price to run higher and take out the Asian high. Let me illustrate this clearly. We want price to move up and sweep the Asian high. Once that occurs, we will begin looking for short opportunities. At that point, we can either wait for a market structure shift and then enter on the retest of the Asian high. This is not a fair value gap and not an order block, which is very important to understand. We enter on the retest of the Asian high and target the low. The low formed previously will serve as our draw on liquidity. That low is our objective. So once Asia high is taken and the market gives us a structure shift, we take the retest of the Asian high, place our stop above the high, and target the draw on liquidity below. That is one valid entry model using this strategy. Another way to enter a trade is through what I call a double purge. The double purge pattern represents a liquidity buildup followed by a liquidity sweep. What this looks like is the market accumulating liquidity in one area. We want to see another sweep of that liquidity followed by a breakdown. This is what defines my double purge pattern. Here, we can see liquidity building around this swing high. The market forms buy-side liquidity and then runs it. After that happens, all we need is a candle close back below the Asian high. We want price to close back inside the range, then take a retest of the Asian high and target the low below. So once again, we wait for the retest of that high and aim for the low. This setup can be traded either using a market structure shift or by using the double purge liquidity sweep, closing back into the range and shorting from the Asian high. These are the two entry models we can use when trading this strategy. In the same way, when we are looking for long positions, we want price to first sweep the Asian high. Once the Asian high is taken, our directional bias for the day becomes bullish. So after the Asian high has been swept, what are we waiting for next? We are waiting for the market to trade lower and take out the Asian low. We want price to move down, run the Asian low, and as I mentioned before, we have two possible entry models here. We can either wait for a market structure shift and enter on the retest of the Asian low targeting higher prices, or we can wait for a double purge setup. We can wait for a buildup of sell-side liquidity, followed by the market sweeping that sell-side liquidity, then breaking and closing back inside the range. After that, we take our long entry on the retest of the Asian low. These are the two patterns we look for. First, let's walk through the market structure shift example. Here we can clearly see a market structure shift forming right here. This area represents our market structure shift. Now, where do we take our long entry from? We do not wait for an order block, and we do not wait for a fair value gap. We take our entry directly on the retest of the Asian low price level. From there, we place our stop loss below the low and target the swing high that formed earlier. That swing high will act as our draw on liquidity. This is our liquidity objective, and that is what we aim for. In this particular example, the trade offers a 3-to-1 risk-to-reward ratio. This illustrates the market structure shift entry model. Another setup we can wait for is the double purge of liquidity that we see here. We have a clear buildup of sell-side liquidity. The market runs through it, and then we wait for a candle close back inside the Asian range. Once that happens, we take our entry on the retest of the Asian low and target the Asian high. If you backtest this properly, you will see that this strategy has an extremely high win rate, especially if you manage your trade correctly once a 1-to-1 target is reached. After price trades through a 1-to-1 risk-to-reward level, you move your stop loss to break even. When you do this consistently, you'll find that this strategy achieves roughly an 80% win rate. However, you must follow the rules exactly. Trading is about executing a rule-based system that gives you a statistical edge. That is what trading truly is. We are not trading based on feelings or emotions. We are trading using proven, data-backed systems that have been tested over time. Now, let's look at our first example. One important thing I forgot to mention earlier is that this strategy only works on the 15-minute time frame. Do not try to apply this on other time frames or ask if it works elsewhere. It doesn't. This strategy is specifically designed for the 15-minute chart. So, here we are on the NASDAQ 15-minute time frame. What do we see? Right here, we have the Asian session. We can clearly see the Asian session running from 8 p.m. New York time to midnight New York time, which is UTC-4. What do we do first? We mark out the Asian high. I'll go ahead and mark the Asian high here. That level represents our Asian high. Next, we mark out the Asian low. Over here is our Asian low, and that completes the Asian range. Now what do? We simply wait for price to take either the Asian high or the Asian low. Let's extend these levels forward. As we can see, the Asian high has not been taken yet, but the Asian low has been swept. Remember what I said earlier. When the Asian low is taken, what is our bias? Our bias becomes bearish toward the downside. So what are we waiting for next? Now we wait for price to rally higher and take out the Asian high before we can frame a move lower. Let's see how price reacts from here. Let's wait and see what happens. Now we simply play price forward and wait for the market to take out the Asian high. Let me draw this level across the chart. Extend it forward. There we go. What do we see? Price has now taken out the Asian high and closed above it. So at this point, we either wait for a market structure shift followed by a retest of the Asian high to enter short, or we wait for our double purge setup. Let's see how price develops. Move price forward. Advance it again. Okay, what do we see here? A swing high has now formed. Before we can frame a trade, we need to see that swing high get purged. Let's watch closely. There it is. Here you can clearly see the double purge pattern forming. We have buy-side liquidity swept, and price has closed back inside the range. That part is extremely important. Now we can simply place our short entry at the Asian high, put our stop loss above the high, and target the low below. That low becomes our draw on liquidity. That is our target. Let's see how price reacts. As you can see right here, price taps us in on the very next candle, and then runs straight through our take profit, giving us a 5.43R return on this trade. Now let's move on to our second example. In this one, I'm going to show you where to place your stop loss when the swing high or swing low is too far away. In this example, what do we have? We have the Asian session clearly marked. Here is our Asian high, and over here is our Asian low. Now we wait for price to take out one of these levels. Let's play price forward and see what happens. Price takes out the Asian high and closes above it. Now what does that tell us? This tells us that our directional bias for the day is bullish. So what are we waiting for next? We now wait for price to trade down, take out the Asian low, close back inside the range, and then we look for a long entry from the retest of the Asian low to target higher prices. Let's wait and see how that plays out. As we can see here, price has now taken out the Asian low. At this point, we wait for either a market structure shift or a double purge, followed by a close back into the range. Here we see a double purge forming, and now we wait for the market to close back inside the range. Let's give it time. Over here, we get another liquidity sweep. There's another purge of liquidity, and again, we wait patiently for price to close back into the range. It is very important that you wait for the candle to close inside the range. Do not rush into a trade just because you see a structure shift outside of the range. You must wait. And what do we get next? Here we have yet another double purge liquidity sweep. And this time, we also get a candle close inside the range. So, what do we do now? Now we take our long entry from the Asian low price level. Where do we place our stop loss? If we look here, we could place our stop loss below this low, but that stop loss is extremely large. However, if we wait one more candle, what do we see? We see a fair value gap form. This fair value gap aligns perfectly with the Asian low. Now we can place our stop loss below the start of the fair value gap. We can put our stop loss beneath the candle that created the fair value gap, which also sits below the body of this order block. Here is the body of the order block. We can place our stop loss below that order block. Now we have two PD arrays protecting price. If the market trades lower, we have a fair value gap ready to push price up. And if that fails, we have a bullish order block ready to support price. So now we have two PD arrays standing between price and our stop loss. From here, we simply target a 2-to-1 risk to reward. When trading this strategy, you should always aim for a minimum of 2R. Now let's play price forward and see what happens. Price taps us into the trade, and what happens next? Price rallies upward and hits our take profit. Now let's move on to the final example. This last example will be a bearish setup. So what do we have here? We have 8 p.m. New York time and midnight New York time marked on the chart. We go ahead and mark out the Asian high and the Asian low, and then we wait for price to take out either side of the range. Here, we can see that price takes out the Asian low. So what do we wait for next? We wait for the market to take out the Asian high, close back inside the range, and then we take our entry from the retest of the Asian high, targeting the swing low below. That is exactly what we are waiting for. Let's move price forward and see how it plays out. Here, we can see that the market has taken out the Asian high, but this is a very important point that you need to understand. Just because price closed above the Asian high and then came back and closed inside the range does not mean we can immediately enter a trade. Taking a position here would result in a losing trade. You cannot trade this setup that way. If we continue to play price forward, what do you notice? That trade would have been a loss. And why did that happen? Because we never received a market structure shift or a double purge pattern. Neither of those conditions occurred, and we must wait until they do. What do we see forming here? We see a double purge pattern, a buildup of buy-side liquidity followed by the market sweeping through it. Now, if we get a candle close back inside the range, then we are allowed to consider an entry. So we continue to play price forward, waiting for price to return and close back within the range. At this point, price still has not closed back into the range, so we remain patient. Here we go. Now we can see that price has closed back into the range, and we also received a market structure shift. This swing low was the low that created the swing high, and price closed below it, giving us our market structure shift. If you look closely at this green candle, what does that represent? That candle forms a bullish order block. This represents a change in the state of delivery. At this point, we are now anticipating lower prices. And remember what I said earlier, we do not enter trades directly from order blocks. We take our entries from the retest of the Asian high. So now, we can simply place our short entry at the Asian high. Once again, what do we see here? We also have an order block within this bearish leg. Because of that, we can place our stop loss above the swing high and target the lows below. However, if we target that low directly, what does that give us? It only provides a 1.278 risk to reward ratio, which is not enough. We want a minimum of 2R. So instead, we adjust our target accordingly. Now we play price forward. We get a clean retest of the Asian high, which taps us into the trade. As we continue moving price forward, we can see that we are fully entered into the position. From here, we simply let the trade play out. And as you can see, on the very next candle, price aggressively moves lower and completely smashes our take profit level. Guys, I really hope you found this video valuable. make sure you hit the subscribe button. Over 80% of the people watching this channel are not subscribed. So if you want to continue seeing profitable, rule-based strategies that can help you become a consistently profitable trader, make sure you subscribe. I hope you enjoyed the video. Don't forget to leave a like, drop a comment below, and I'll see you in the next video.